is not good. It means there's a shortfall. We have to do better. Having kids, the statistics say that having a child, okay, up to the age of 18, it will cost $233,000. Now, I didn't say it, it is the statisticians, okay? So imagine, take this $233,000 and multiply it by the number of kids you got. That would be a lot of money. So here we need to empower ourselves to prepare ourselves for that. We want to prepare yourself for college, prepare yourself for college costs of the kids, etc., etc. So it said that 95% of Americans are in this bracket, family A. Okay, we live from hand to mouth. You get your paycheck, you pay your taxes, living expenses, debt. So family A, it is almost improbable that they will get out of that situation. Most people believe, except if you're in the lottery, etc., and yet still you need to know how to manage this. So 95% of America is represented by family A. So we say there's a retirement, education, spending crisis. People don't have enough money. Particularly with the onset of the pandemic, we've become marginally worse. People now are going on the food lines for free food, food stamps, etc., etc. Where we would like to be is in family B. Family B is where the rich and the wealthy reside. And if you notice, if you look at that graphic, the only difference is that they're able to pay themselves, put money aside for the wet days. So this is our aim when we become financially literate. We want to be able to pay ourselves first, put something aside for retirement, etc. Protect our families. So the basis of being financially literate comes down to what we call the 3 rules of money. No matter where you are, what the financial institution, the bank, investment company tells you, it all boils down to 3 rules of money. So I'll tell you about the 3 rules of money. Right. So the 3 rules of money is a very, very, very powerful tool. It has to do with, number 1, compound interest. Number 2, taxes. Number 3, with investments. Compound interest, it can work for you or it could work against you. It can work for you in terms of your money growing. It could also work against you in terms of your debt, your mortgage, your credit card, your car notes, your student loan, etc. Compound interest is working against you, which means that you're getting progressively worse. You need to know what to do, how to counteract that. But let's see the situation there. Let's see how it can work for us. This is what we want to empower ourselves with. Again, this is what the rich and wealthy know, and they use it to their advantage. And this is what the financial institutions, the bank, they will not tell you. They don't want you to know this, because when you know this, you're able to make better decisions. So with compound interest, there's something called the rule of 72. Simple. Take the number 72, divide it by the rate of return. It will give you the number of years it takes for your money to double. So say you invest $10,000, any amount. We're using $10,000 here in this case at 4%, okay? The rule of 72 tell you, take 72, divide by the rate of return, which is 4%, you get 18. What does that mean? That means every 18 years, your money will double. So 10,000 today, in 18 years will become 20,000. In another 18 years will become 40,000. Same thing if you have 8%, 72, divide by 8 equals 9. That means every 9 years, your money doubles. So 10,000 today, in 9 years, 20,000, 18 years, 27 years, in 36 years, 160,000. Now note the margin, the variance in between the two. But we want, the aim is to place our monies where we get the highest rates of interest. So we're looking at 12%. You'll tell me, Rowan, where can I get that sort of interest rate? It exists. Again, this is what the financial institutions know that they will not tell you. Yes? Somebody said something?
Questions after.
Yeah, thank you. So says the 10,000 at 12%, 72 divided by 12, that's equal to 6 years. Today, 10,000 in 6 years, 20,000. In 36 years, you'll get 640,000. So what it shows is compound interest is really interest upon interest upon interest. This is what you want to happen to the money that you're saving. Wherever you put it in, that's what you want to happen. So the bank, this is what the bank knows. The bank will take your money, okay? Take your money, or they'll give you the loan, and they will make that sort of interest. And you look at the difference between the 4 and the 12%. 46 years at 4%, 46 years at 12%. The difference is 600,000. This is what we want to arm ourselves with. As I said, it could work for you or against you. The second rule is taxes. Now, taxes is combined, intermingled. If rule number one, when you've made, say you've been using the compound interest rule of 72 effectively to work for you. So you're making that money. When you come to take that money, at some point, you got to pay taxes. Okay? We want to pay to Caesar's what is Caesar's, but we want to pay the fair share. We don't want to pay more excessive. So we want to do it smart. So there are 3 tax buckets. Tax now. This is where you get from the banks. You get your checking account, savings, CD, stock, mutual funds. What that means, Coles, can you mute for me, please? What that means is that when you get the interest, your mutual funds, your savings, you pay tax immediately. Tax now, okay? Tax later, as it says. You don't pay taxes now, you will pay it later. So I'll ask you, which one would you prefer? Would you prefer to pay the taxes now on the monies that you invest in, or pay it later? The answer is, we prefer to pay it later. Obviously, you'd prefer to pay the taxes now on the seed, where you are certain of what you're paying, than to pay it later. Tax later is like I'm saying, give me a loan. I ask you for a loan, you give me a loan. When I ask you how much will I have to pay, you tell me, oh, don't worry about it. I'll tell you later. That's very risky, because that means you could make me pay an exorbitant amount. I prefer to know now. I prefer to pay the taxes now. So the accounts under the tax later would be what is very popular in America, 401k, 403b. What is a 401k? What is a 403b? All these accounts, IRA, SEP IRA, annuity pensions, these are simply accounts that the IRS says it's valid. We will not charge you taxes. From your payroll, from your W-2, payroll deducts the money, okay? They put it aside, they invest it. You don't pay taxes on this, okay? However, you will pay tax later. So that's what it says, tax later. But you know, with the pandemic and particularly the world environment what's going on now, we don't know how much the taxes will be. Do you think taxes will be going down? Absolutely not. It will be going up, most likely. Now, the Congress in the United States is debating charging people taxes on capital gains tax. Capital gains. That means unrealized capital. It means if you got money, you made money in stocks, even before you sold those stocks, you haven't realized the money. They want to charge you. They're planning to charge you interest. They're going to start if the wealth and come down. So most people, I know I would not want to be in tax later. I would want to be in what we call tax advantage. Tax advantage, as it says, you pay the taxes right now. From the payroll, taxes are deducted. And so
Right.
what goes into my taxes deducted now, and my afterpay, okay, goes into the investment. So I think, and I'm sure you will think, that's a safer, more reliable place to be, because your money could grow and you guaranteed you wouldn't be paying taxes. The accounts that fall under that include the Roth IRA, 5 to 9 college savings, executive bonus, long-term care benefits, cash value of a life insurance. Now, when you come to take that money, okay, that you've invested, what or how do you take it? You need to look at your investment options. Where you're going to put that money, how you plan to take it out. There are 3 buckets: simply, fixed, variable, and index. Fixed is what you get at the bank, your savings, your bank. And by the way, this does not only apply to the United States or Canada or the UK. it applies to St. Lucia. The banks in St. Lucia, it applies around the world. That is how finance works. So that's why we will do those presentations occasionally to educate ourselves. Because when you're armed with this, you can make better decisions. So fix, you know, that's basically the bank. You put money at the bank. Again, your checking, savings, CD, stock, mutual funds. Okay. Yeah, when you put those things at the bank, you know it is there. You have safety. Okay, hurricane could come down, the world could pass away, move. Your money is there. So we said there's safety, but guess what? You said it's straight line, it means there's no growth. I don't think you're in business for that. You want to put money at the bank, of course, to go and take out money to buy lunch or quick emergency. But when you're thinking about long term, okay, when you're at that point where you're not working, etc., you want to look at something that's investing for the future. The bank is not the way to go. So we look at what we call invest if the variable options. This is what you get at an investment company like Voya, Mutual of America, etc. Cryptocurrencies would also fall under this, the variable, Bitcoin, etc. Why? They tie to the stock market. Now, as you could see here, there is growth. When the stock market is doing well, you go up, you make money, you're happy. However, when things are going down, like it did during 9/11, like it did during 2008, the stock market crash, okay, 2012, during COVID, the market goes down tremendously, you lose money. So what it means is that the monies you've invested, okay, your own money, the value is lost. When the market begins to go up, you go up. Going down, you go up, your money lose. Now, as we said, the accounts under that variable would be 401ks, etc. People don't know it, but most people, in fact, everybody lost money during the pandemic, the height of the pandemic. They don't know. You're not checking your statements because people are not educated in that. It means if you put $10, it might have been matched, but then you'd have lost the value of your $10, okay? And it would take much more. You'd have to put in much more. The statistics have shown for you to catch back, okay? Where we want to be ideally is a hybrid of the two, the fixed and variable. We call it index. Why? You got safety. As the stock market is doing well, you go up, okay? Then things happen, the stock market is headed down. As you could see by the gray, lightly shaded line, guess what? You're locked in. That's why we call it indexed. You're locked in, you don't lose money. The value doesn't go down. You don't lose one peco. When that begins to go up, you go up, you begin to go up. So you've not lost money, you're going up with it. Market goes down, you're locked in, etc., etc. So we said there is safety because you don't lose, and there is growth, okay? So ideally, to be financially, when we say we're financially literate, whether we have a little kakada or we have a little something put aside, ideally, we know we have families. We may have a girlfriend, wife, child, jabal friend, children, grandkids, etc. You want to make sure if you're not there, something happened, God forbid, you pass away, that you protected. You are protected and your family. Also, you want to ensure that if something happens to you and you're alive, but you're not working, you don't have gainful income, you want to put something in place that you can have income, okay? So simply, what we use to gain those benefits, we use the life insurance companies. Now people say, why? Insurance, may public and software. But we take insurance to protect our phones. We take insurance to protect our houses, our car, etc. We take something from courts in St. Lucia, you take something on leeway, anywhere. There is insurance, okay? Even professionals take out insurance. Why? Because you need to protect yourself in case somebody sues you. Malpractice insurance. So what I'm talking about in terms of complete holistic protection we're looking at is simply what you'll get from the index strategies in a life insurance company. And life insurance companies don't have to do, when we talk about life insurance, it's not only for the dead, it's for the living, as I'll show you. We want to ideally put ourselves in position where we have the 4 cornerstones, meaning growth, safety, we get the tax advantages we spoke about, and protection. One of the things one of the products I like and I'll refer people to is what we call the Index Universal Life. Index Universal Life is given by very few insurance companies up in the United States, but I'll refer this product particularly to the one of Transamerica. Transamerica is a very, very strong financial company. I'm with an organization called World Financial Group, and Transamerica is our parent company. In fact, World Financial Group, it's a marketing arm of Transamerica. We work not only with Transamerica, but we work with 80 different financial companies. That includes investment companies. Hence, myself as an agent, knowing the community in St. Lucia and the diaspora, myself and the other team members who work with me, we have many team members, not only myself, we are able to tailor a product for you, whether we need kakada or you have something put aside for wet days. It's not about us, but it's about you. So the Index Universal Life, what it gives you, there is growth. It has three aspects: the life insurance, okay, it has the long-term care, and there is the cash value, which is index. So with there is growth, because when the market is going down, doing negative, you never, first of all, you're locked in. Even when the market is doing negative as it did during COVID, you're locked in, you still get 0.75 of 1%. And I'll show you briefly, because my presentation is coming to end, I'll show you briefly how that impacts you later, okay? So there's a cap at 15%. If the stock market is doing 15, you get 15% on average. If the stock market is doing negative, like it did during COVID, you don't dip in there. You still get 0.75, so you never lose. Which is what I'm talking about, the guarantee. There's also tax advantages. The 401k, the 401k, the 401k, the 401k 403b, those accounts is spoke under, okay? These very accounts right here. Those accounts, there's a catch in it. The government tells you we're not going to take out the taxes now, we'll take it out later. However, you cannot touch that money until you're 59 and a half. God forbid, if you have an emergency, then you got to touch it. But guess what? You have to pay taxes, you have to pay penalties on it, hefty penalties, and other charges in this, just for touching that money. So I'll ask you, would you want to put your money in a account or an financial instrument where you know you cannot touch it? You got to wait till 59 and a half. And even when you're 59 and a half, there's so many charges on those things associated with 401ks. It's what of most American knows, okay? But it's a good thing, but it depends on the situation. With the IUL, the Index Universal Life, this is your money. Now, what we're talking about when we talk about retirement, we're not talking about putting monies away today and taking it out later. We're talking about a long period, 5, 10 years plus, because we want to invest in ourselves. As I showed you early on, the longer you leave the money, the more compound it gets. Interest upon interest, that's interest working for you. And this is what you want. So with the IUL, you're able to take out that money, you're able to take a loan against it. The money is tax-free, okay? Because it's after taxes, it's tax-free. You could get access at any stage, unlike the 401k. Also, there's protection for yourself and your family. God forbid if something, you're the main breadwinner. If something happens to you, you have a beautiful wife, girlfriend, jabal, you have kids, grandkids to take care of. You want to ensure that if something happens to you, they're not suffering. The mortgage is paid off, the house is paid off, okay? You want to ensure that the bread is still coming in. So there's long-term care. But what if you're not dead, but you cannot work because of healthcare matter? In the United States, little monies that you have aside, if you have a health matter, insurance companies try to pull away. Well, I shouldn't say health. The health insurance will not support you on all of this because you cannot work, you have a life, you have a health issue. What you would like to do is to have what we call long-term care. And this is a product of the Index Universal Life. You would like to have long-term care that helps you with 6, if you cannot do 2 out of 6 activities, the medical doctor, not myself as an agent, but the medical doctor will say, this person needs long-term care, and you will get it. The insurance company will pay you 2% out of your face value. So if you have a policy, say for 100,000, they pay you 2% every month for nursing services. Because generally, if you cannot, the 6 activities, if you cannot do 2 out of the 6 activities, walking, toileting, transferring, continence, bathing, dressing. If you cannot do 2 out of the 6 activities, then you need help. So long-term care. In addition, there's critical illness and terminal illness. God forbid if you get cancer. God forbid if you have a terminal illness and they said you have 6 months to live, a year, or you have heart attack or stroke, the insurance company will begin to pay you that money, okay? Pay you that money. That's why we say the life insurance is not just for it's not for the dead, it's really for the living. So that sort of thing. So in my presentation is coming to an end. What I would like to do, bear with me please. So I was showing you here, if you look at this chart here, it will tell you the index universal life. It operates on an index, an index of, we have various stock trading exchanges here in the United States, but for the IUL, we use the S&P 500. That's some of the highest, the best, most the quality 500 quality companies, some of the big companies that we know. They take the financial results and they average it here. So the IUL uses the S&P 500 from the United States, the US Stock Exchange, and the China European Stock Exchange, Hang Seng. So we look back to see how the IUL, Index Universal Life, did as compared to the weighted index change of the S&P 500, the Euro stocks, and the Hang Seng. We see in 2001, it was negative 1604. Sorry, the weighted average was negative 1604. 2001 at the top, what did we have? We have 911. Everything went down. So you invested 10,000, because of the negative, it would have taken you to 8,396. However, you get in, remember, it's the IUL operates on an index strategy. No matter what anybody tells you, it comes back to the free rules of money. No matter what advice, etc., comes back to the free rules. So an index strategies are the better and the safer way. So in 2001, the IUL, you got 0.75%, whereas the stock exchange average went down 16.04%. IUL, it remained positive. You still got 0.75 of 1%. So your 10,000 under the weighted average would have become 8,396. However, your 10,000 here to extreme right, if you watch the cursor, comes up to 10,075. 2002, it was still negative, coming from the effects of 9/11. You lost money again, 6,294. What happened to your index, your IUL money? Index, it went up 10,150, and it comes up. Let's go to 2007. It did 9.91. So it came up from 11,380 the previous year to 12,000. With the IUL, the index, you got the same 9.91. Now, if you notice at that point, at 2007, you have 12,507, but under the index, you have 18,144. That's because your money in the index strategy is growing. You haven't lost. So we come up to 2020. 2020, okay, you'd see that the weighted index was 5.72, the average for that year. To 2020, that's what? The year of the pandemic. You would have had $19,580. What did the IUL index strategy do? It still had, you still got the same 5.72, okay? Whatever you get from the market, you'll get in the IUL up to a cap. So your 10,000 you started with, it's now 48,360. Again, that's the powers of compounding taxes as well as the index strategies. So the question is, Rowan, how much do I need to have at retirement? Again, as I said, it's relative. Some statisticians, some financial people say you need to have 20 times what your annual salary is. For most of us, that's difficult because we're living from hand to mouth. There's something called DIME. What is DIME? DIME simply means D for debt, I for income, M for mortgage, E for education. That is your debt, your total of your outstanding. The DIME simply tells you what you're working towards, what you should ideally have by the time you're ready to retire. If you fall short of it, then you know you need to put in some strategy in place now to get there for retirement. Otherwise, you'll be in a little problem. You'll be in a deficit, yeah? So DIME stands for debt, your total outstanding debts. Your funeral costs, you have to budget for that. It's good to have a funeral concierge. If you're dead today, even if you have life insurance, the money is not going to come out of the sky. You need burial money within 48 hours. You need to have things moving. So it's good to have a concierge policy. Our team, World Financial Group, we can help you with that as well. A will. You don't necessarily have to write things on paper. And now things are very electronic, and you could change it as you please. Okay, you have access to it, and your legal people. It's all digital now. We can help you with that. Income. We said multiply your annual salary by the number of years you want to cover your family. Maybe after you retire, maybe 10 years, you need money's coming in. M, mortgage. You have a mortgage? You need that covered. E, education. You want education maybe for yourself, for your children, grandchildren. So DIME, simply you put in those figures. Your debt, your total debt, whatever it might be, student loans, car notes, whatever it is, you put in it here. Your income, what is your annual salary? If it's 40,000, 50,000, multiplied by 5, multiplied by 10 years, you'll have an idea what that is. Your mortgage, if you got to pay up your mortgage today, or say in the next 5 years, get that figure. You could get it from the bank or the financial house. You plug it in there. And your education, you want to cater for your kids. You don't want them to suffer. You want to give them that education. So you got to budget from the time they're born to 18. You got to budget. So the figure you would get there, it's called DIME. That would tell you how much you need. So we say the best way to cover that is having insurance. Not necessarily an IUL if you cannot afford it. They're cheaper. It's better to have some protection than none. Cover yourself, your family, because we don't know when is our time. So there's different types of insurance. Our group, myself, we can help you with that. There's term life, which is the cheapest. Okay, you could spend as much as $1, $2 a day if you can. That's when you pay for the train, etc. Put something aside to get you some insurance. Okay. Myself and our team, we work with about 80 financial houses, investment companies, insurance companies. That includes Transamerica, Everest, Prudential, some of those big names that you've heard. We all work with them.